Hi, and welcome to the Macro Show. We talk macro and try to make sense of markets. Now, wait, I know what you're all thinking, right? Is he going to wave the white flag? Is this it? Is this the end of the bond show? Is the kingdom a farce? Yes, the crown did take some damage today. I'll have to repair that. They were trying to steal my jewels. The answer is no, because today is story time with the bond king. But in addition to that, we're going to look at the signals that perhaps inflation has peaked and perhaps bond prices are bottoming. I know you're probably thinking that's not possible. We're going to answer the question that always happens during this time: is the thesis broken? No. We're going to look at a chart from our buddy Colorado Travis, some economic data, talk about the TGA. I think we need to go into a special. I got a whole presentation that I grabbed today from the U.S. Treasury. I think we need to go through that, but not today. Talk about 2 and 30-year yields, which is really important. What's going on with the bond market? Why is everyone selling? Like, what gives? All right, first let's talk story time. Because some of you threw it right. Some of you probably waved the white flag, said, "I'm done with this. I'm out of here. This is no good." So I'm going to tell you a macro story. This is a true story. It does come with a 3-letter initial, a story that I've said I would eventually tell in the full amount. Very few people that are watching this know. Almost nobody knows this story. But you're probably wondering, how is it I cannot be quitting now? You have to think everything's going against you. So here's a story for you, true story. A while back, I think about 2 years or so ago, I was looking over my macro thesis and I said, okay, I feel really confident about something. So what is the highest risk, highest reward position I could take? And I put a lot of money in it. And then it went down. So I put more money in it because I didn't put all of it, but I put more money in it. And it went down some more. And then I put some more and it went down again. And it kept going down a lot. And I kept reviewing. The key is I went through my data. And this is one thing that there's 2 things you really learn from macro: patience and trusting your research. In my research, I went through it day after day after day after day. And it was good. What was happening is people were selling against my view. So I continued to buy the dip whenever I could with whatever I had, until I had pretty much my entire net worth tied up in this thing, in one thing. Because, if you're really convicted, people are, "I'm really convicted about this." Yeah, well, put all your money in it and then come talk to me. Because if you put all of your money in something, you will become an expert. And if you're not, you will soon. You'll find every last person. You will find out what's true, what's not true, what's right, what's you will know. And at the worst, I had suffered from my cost basis a 60% drawdown of my entire net worth. Now, some of you probably say, well, it's just about $5 if he's lucky because he's got that wood paneling. No, 60% of my net worth, substantial amount of money. And I didn't sell. Now, a lot of people would have sold, right? They would have been gone. Oh man, if I'm down 5% or 2%, 10, 60, you're crazy. But my data was right. And then the market turned in my favor, because data always comes out. Because see, some of you invest, pitch to pitch, right? There's a game going on, but you're betting pitch to pitch or inning to inning. I play to win the World Series. And I know to win the World Series, I got to give up some pitches, give up some games, give up some streaks. But I have to trust my data. I have to trust my team. When the turn came, it was slow at first, and then it took off. When I sold those positions, and I want you to think of your net worth and put a minus 60% underneath it and tell me how you would feel. When I sold those positions, it was 129% gain from my cost basis. Now, some of you are smiling because you're doing the math and you're like, well, if I had all my money in that and it went up 129%, wow. See, I play to win in the end. And I don't worry about selling, because when that turn came, I wouldn't have had the fortitude to go back into that position. I would have, have you ever been in trade and lost money, right? You quit and never, I'm not going to look at that again. Now, I swore off I will never, ever invest in that again because it's way too risky. I do other risky things. But when I look at what's going on in the bond market and I go through my data every day, and we talk about it on the show, is there anything wrong with the data? No. So what do you think I've been doing lately? It's called an anagram. We'll fill it by the, yes, that's what I do with an S, not the one. Buy the dips. That's what I've been doing, because here's what happens. Just like before, as it went down and I bought all the way into the bottom, as it went up, all those little dips turned into nice gains. And so that's why, my friends, I don't enjoy this any more than any of you. But no, I'm not throwing in the towel, because I know when this thing reverses, it's going to go slowly at first where no one will look, and it's going to go really fast. And I plan to make bunch of money on that, just as we've talked about. If you understand duration, and then you look out the risk curve, the duration curve, is Travis Kimball and I have talked about, in his recent Real Vision interview. We talked about how, look, you can pretty much own bonds because so it goes down in value. You still get to collect a dividend along the way. You can sit there perpetually. It's not like you're triple short the NASDAQ or something. I mean, look, there's certain things that you cannot do, but there's certain things that you can sit on because you know how it's going to turn. So let's talk about, the signals that inflation has peaked, because if it has, this is a huge problem. And if it has, and the same signal can be used in the bond market, it's telling us something pretty good is coming. Now, we went through this on the dollar on Monday's show, but let's go back to that same chart and compare it to some other stuff. The ISM Prices Paid. Now, this is a diffusion index. So for those who are watching this for the first time, anything over 50 is an expansion over the prior month. Anything under 50 is a contraction over the prior month. And anything right around 50 is unchanged. Now, the ISM is the Institute for Supply Management, and they poll purchasing managers at manufacturers. And they tell us what, and a multitude of things, but one of them is prices paid, and prices paid is really high. And somebody said, yes, there's inflation going on. Broad-based, not so much. There is broad-based inflation. It's just more disinflation than it is. Definitely food inflation, but look at what's going on prices paid. Now, let's compare this to the Consumer Price Index. So where are we at here? Roughly middle-ish 2008, and we go to the Consumer Price Index, middle 2008, peak of inflation. How about the bond market? Well, let's go over to TLT, right? Because that's what we look at on the show all the time. And let's go find middle of 2008, 7 here, right? That's 2009 here, right in here. There's a bottom in the bond market. Wow, that looked like that would have done pretty well. All right, let's go back to the ISM here. We see two peaks, one kind of early 2010 and then a bigger one kind of early 2011. Let's go see here, early 2010, boom. Yeah, this was a little later now in 2011, August, September, but pretty close, right? Pretty close. Now let's go look at TLT, and what do we say, 2010, early 2010 starts to get into a bottom, and then here's early 2011. So here's that 2010 bottom. That would have looked good. Here's that 2011 bottom. that would have done pretty well, right? These were, 90 to the first one, up to 108, and then up to, near the 130s. Wow, that's pretty good. Now let's go back to the ISM Prices Paid, and we've got mid-ish 2018. All right, mid-ish 2018 right here. CPI is peaking. How about TLT? Mid-ish 2018. Whoops, way up here. Right in here. Now you say, but it went down. Yeah, it went down. So let's say you bought here right around 120. Maybe you sold up here in the 170 or 180. That's still a pretty impressive run for a government bond. Got to keep that in mind. It's a government bond, not an equity. How about now? Prices paid, highest level since 2011, maybe tying, possibly, maybe the highest level since 2011, or maybe tied with it, close enough for a chart of this nature. And where is the CPI? Well, Oh, it's right here. Now, can you imagine right now if this is the peak of the CBI? This was a peak and it went negative. Here's a peak, went negative. Here's a peak, and then we got a second one. That tells you that the CBI is probably going negative. Now, if you own bonds, you are thinking, man, is CBI going negative? Cha-ching, that's a big deal. Now, it's not going to happen tomorrow, but it's telling you that in the months to come, this ISM chart is right, which so far it has been. That's coming. Now let's go and look at bonds, right? Where's TLT right now? Where no one wants to own it. Where probably many of you have just sold. And we zoom in a little bit here. Oh, it's at a low point. That's not inconsistent with what we've seen in the past, where there is a bottom and then maybe a little lower bottom. And then you actually, it's going to go up a bunch. And here's what's more interesting. Because if you talk about thesis as being dead, as always comes up during this time, let me point you to the one thing that does matter. Oh, the Fed's buying bonds, and they're buying a lot of them, $10.5 billion a 30-year, and they have the option to buy more at any time they want because they can buy any number of them at any time. And so that tells me that, hey, I don't have to worry about things going down perpetually because the Fed's buying. And even better, the ISM now is telling me that inflation's perhaps peaked. And if that's correct, the consumer price is going negative. And if you look at when it went negative, here, let's see, 2015. I didn't look at this. 2009. Let's go see what would have happened to bonds in 2015. Just for fun. Let's see, 2015. Yeah, there you go. Bottom to peak. 2008. All-time high. So there you go. All-time high to all-time high. All-time high in bonds sounds really good to me. Especially since the CTAs, those quant computer programs, they buy in right here, which is roughly about 5 to 6% up from where we're at now. I checked, there's no downside risk of them, but that's pretty cool. Now, is it possible that this will go up 5 or 6% maybe the next couple of months? Yeah, and when the CTAs start clawing back in, oh man, everybody who's short is going to be doomed, because the other factor here is you've got everybody short. The 34 and a half years of the 30-year bond, or 35 years it's been around, you've never seen in 6 months more selling than you have right now. I like that bet a lot. In fact, I like it a lot, so much, buy the dips. But that's me. I'm not saying that's just you. It's not investment. You need to do what you need to do with your money. I look to win the games. Because remember, what happens when I win that game, right? What happens when this move peaks, right? And let's go back to 2008. Boom, right here. Or 2009. Yeah, 2008, 2009, December, February, whichever you like. You get a big breakdown in gold miners. Oh, that'd be right here. And then what? 300% return in 2 years. I'd really like to have this, a lot more money right at this time. How's the only way I can ensure I'm going to have it? Oh, the bond market. Now think about that. Put 300% behind your net worth and tell me how that's going to feel. I'm willing to wait. I know a lot of you aren't, but we're in a world where people don't even keep security for a week anymore. They trade so much. All right, so thesis isn't broken. Let's go and look at this great chart. That's not the chart we want to look at. Chart from Colorado, Travis. There's me. We don't want me on the screen. Have a little trouble here. There we go. All right, on to, we got to go to the economic data. Sorry, Travis. We'll come back to you. Don't worry. All right, into the economic data. So what's been driving up this little blip in the bond market is a little bit of inflation. South Korea, CPI, 0.6%. How about out of Europe? This is what really is getting people excited. We'll catch, I think that's in today's data. Redbook, same store weekly sales up to 4.4% year over year. This is probably now where we're seeing, this could be the peak of the stimulus, don't know, but this is what we're seeing is likely stimulus checks hitting here. Let's go on to total vehicle sales up slightly. This is mostly due to truck sales. Japan services PMI still contracting over last month's contraction. How about the cakes and services PMI in China? Almost unchanged. So very slightly up expansion, but at a very slow rate compared to the prior month, saying that that's peaking out. Maybe a currency deval from China will be coming soon. We've got all kinds of services PMIs. Look at Italy, further contraction. How about Germany? Further contraction. How about the broad Eurozone? Further contraction. Great Britain, ouch. Big contraction at 39.5. So you see contraction. Here's what got the market excited. CPI, our bond market. CPI year over year preliminary in the Eurozone is 0.9. We went from deflation to inflation. And now they're all saying it's oil, which I'm not disagreeing, saying that oil is a factor here. But is part of this other problem the euro currency going down? Could it be the dollar now headed higher and looks like a small head and shoulders bottom, moving average starting to bottom out? This could change the whole inflation narrative. Yes, they could see inflation in the Eurozone due to a declining euro against the dollar, but this also supports that. You remember that chart we looked at, the prices paid, is saying, look, that coincides with the bottom of the dollar. Wow, how about that? How cool is that? Dollar starting to bottom. That would be disinflationary and potentially outright deflationary for the U.S. Producer prices still negative in the Eurozone. So the question is, what is this CPI up for? Is it due to food? I'm not entirely sure. I didn't look into it too deeply. Moving into today's data, ADP non-farm payroll showed a gain and an improvement over last month's decline, so 174,000 jobs. If you think that's great, it's not. It's pretty weak. Car sales, while up over last month, are rolling over and slowing down. Truck sales are hot. People must be buying a lot of trucks. Services PMI in the U.S. expanded at a slightly faster rate due to, according to the market. And the ISM non-manufacturing or services PMI also expanded at a slightly faster rate than the month before. Looking at the ISM data, here we see services PMI growing faster than expected. Again, I mean, you have to look. These are coming off a super deep level. And I think the market one reflects this more accurately. We just started seeing an expansion in this back in October, and it wasn't much. So this, it's not like the services sector is just booming here. It's just coming slowly back from the dead. Looking at the details here, what do we see? Inventories contracting slightly at the services level. Inventory, customer levels too low. So what is the most likely problem? Supplier deliveries seem to be consistent problems. New orders are up. So services are showing a bit of a rebound. But again, due to COVID, there's a lot of problems getting those services out to the customers. How about today's crude report? Down 994,000 barrels. Looks like distillates down 9,000. But here's a big one. How about gasoline inventories? Up 4.466 million. Imagine unemployed people not driving to work. This is one of the highest levels. The peak in this was back in January 2020. The peak around 260,000 barrels, somewhere right in there. And what we don't want to see, if you're bullish on crude, is a continued increase of this. You want to see, by mid-February, right? This should be rolling over and heading down. This is pretty consistent. You know, you can see here, kind of February, March. This needs to be rolling over. And if it continues to rise, it's telling you there's really serious supply problems in the market. All right, let's go to, here's that chart from Travis. We'll get to that in a second. I know he's waiting for it. All right, so this is the TGA. I need to do a whole deeper show on this. We looked at this before. The real question, and this kind of came up on Twitter yesterday, is a decline in the TGA bullish or bearish for bonds? The answer seems to be broadly believed that this is bullish for bonds, bearish for yields. And the reason this is not because the chart will really tell you anything. It's because what's happening is the federal government's going to spend down its checking account. Now, it's not supposed to normally be this high. There's a level where they're supposed to keep it at, but the CARES Act boosted it up, and it was just eventual that now Treasury Secretary Janet Yellen would be the one to bring it down, or would have been Mnuchin had President Trump won re-election. But this would have had to been brought down to normal levels. So now she's going to have to do that. And this gets this whole, it's bullish for equities. You hear this all the time. Bullish for equities. We looked at that, not inconclusive. It's going to be totally bearish for bonds. Again, inconclusive. The real way you need to look at this is the Fed is going to reduce its offering of treasury bills and wind down the balance sheet by rolling off a bunch of T-bills and canceling some T-bill auctions. They're going to do away with them. I mean, maybe we'll come back someday, but they're going to stop doing them. And so the notion is that will, so if you're a T-bill buyer, right, you're out there trying to get as many T-bills as you can right now because they're going out of style, and maybe you can't get them, so you start buying short-term notes. And if you're a short-term note buyer, now you can't get that because you've got new competition, so you're out in the intermediate-term notes. And if you're an intermediate-term note buyer, now you've got extra people bidding, so you go out the long end of the curve in the bonds. The idea being, due to quantitative easing and restricted supply, when there is a time of high demand, which we've seen in the auctions, and the T-bill auctions are just super, super strong as people are desperate for collateral, or high quality collateral. So what can we take from this chart? Well, not a whole lot. What we can take from it is that it's most likely going to lead to lower interest rates and higher bond prices. We'll find out. So this is a cool chart from Travis. Sent this over to me today. And what you see is people that believe bond breakouts are coming. And you can see he's drawn these wedges. Now, this is a ascending triangle pattern. And usually the way these works, and when you break through the top of it, now you've won. The bears in this case have won. And yields are going straight up. But yet every time you get in this pattern, it collapses. Gets in this pattern, collapses, pattern, collapse, pattern, collapse, pattern, collapse. Breakout, nope, collapse. Pattern collapse, and here we are breaking out a little bit. Likely direction is a collapse. If you know nothing about the bond market, we need to talk really briefly about today, and because of story time, we're going to go slightly long. So what's going on in the 30-year is you're seeing people that are forced to sell, and they're selling at any price. I mean, they really don't care. I mean, and we don't know why. We don't know who or why, but we do know they're selling at any price because it doesn't matter if it goes down. They're just selling. Now, it's not the CTAs or quants. I looked up that, and the movement of it is not consistent with what they do. So is it the fact that people do need some pristine collateral and are selling the 30-year to get to get T-bills or maybe notes? Because we're seeing in the short-term note market, no movement. We're going to look at that. Maybe they need dollars because liquidity is being drained. I mean, without all of these new auctions, there's going to be a fight for this short-term collateral. But there's one thing, if there's one thing of all things that you say, well, how can you be so sure about everything, even if even if you don't even know anything about bonds? It's because of the relationship between the short end of the curve and the long end of the curve. A lot of people think the long end of the curve can just spiral out of the control and it leads the short end. Not true at all. Think of the long end as a tail on the dog. The tail can wag the rear end, right? We've seen dogs do that. They get real excited and the tail, shakes the back end. But the nose, the front of the dog, the T-bills, and then the notes, short-term notes behind that, the head and the neck, that all leads. And the rear end can swerve around a bit, but it's the short end of the curve that leads. That's why when you go look at these T-bill auctions, you can see right now that bidders are paying virtually 0% yield on just to get them. And when you look at the 2-year note, you can see it's not moving at all. It's just pretty much the long end of the curve. So here's a chart of the 2-year versus the 30-year yield. Because somebody's saying, that's not true. They won't go together. Yes, they do. And you can see it right here. And they're even on the same side. So this is a left justified chart. You can go pull it up yourself. And you can see 2-year in blue, 30-year in red. And they go right along with each other. And they go down together, up together. And then here you go. See, 2 years going down, down, down. 30 years going down, up together, down, up, down. And here's the point. 2 years we're going up, 30 years we're going down. And there's some problems because people think that this is not how it works. And here's a good example is right here. Look at the red. You see it going up? Bond route. 2 years go down. Oops, no bond route. Bond route. Nope. Back down. Bond route. Nope. Bond route. Nope. Bond route. Maybe. Bond route. We got it. Nope. Down. Bond route. This is it. This is the one where it detaches. Look, this goes all the way back to 1977. 1977. There's a relationship. The long end of the curve doesn't deviate from the short end. So what will happen is when the long end finally breaks lower, that's when pandemonium breaks out in the markets. Now let's look at this on a chart So I've got my trading software here. Let's go pull up an overlay TLT so you can see with a real actual ticker instead of the Fred charts. And we'll go to max weekly and you can see, aha. So what do we have it overlaid? 2-year treasury yields or 2-year treasury bonds. These are bonds. So TLT, 20 plus year, 20 to 30 year maturity versus 2-year maturity. And look what happens over here. Look, bond drought, bond drought. Oh, wait, no, 2-year yields go, 2-year bonds going up. Oh, we're going up too. And look here, bond drought, right? 30-year going down, bond drought, bond drought. Nope, 2 years going up, boom, 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 up, up, up. And now they're falling together, rising together, falling together, rising together. Here, let's zoom in. Dislocation, bond drought, nope. And now you have, let me zoom back out, the biggest dislocation between the 2-year, maybe the biggest dislocation. Let's go all the way back to this first one. This one's not, I don't think this one's as big. It's big, yeah, maybe. No, because 2 years prices came down. So you have right now a massive dislocation between the 30-year bond and the 2-year bond. So what does that tell you? Well, it tells you one of two things. Either the 2 years coming down, which it really doesn't look like that because it's actually been going up, or at some point there's going to be a massive move higher in 30-year bond prices. You can even look at it against short term. Here's iShares 1 to 3 year. And you can see, look at this relationship. It's rock steady. I mean, they move together, up and down together. Away they go. And you zoom in. Here, what if you say, well, you got to run your own charts. You'll see it. They move together. See? And when they get dislocated, they come back together. And here you have biggest dislocation, or one of the biggest dislocations between short-term notes and bonds. How does that resolve? It's going to resolve with bond prices going way up. Last thing I want to talk about is someone pointed out on Twitter to look at the money flow. And so this is a great indicator. I pulled it up down here. I'll make it bigger. And what you're seeing here, this is the Chalkin money flow. And when it's above zero, it's showing accumulation. And what that means is even though prices have been falling, there have been buyers buying up these shares. And that's unusual. Normally you see money flow, like here's an example, it goes up, price goes down, people go out. That's normally what you see. In fact, the last time we saw the money flow go up during falling prices, it went back to new all-time highs. So it went from here, people, prices for selling, but someone was accumulating shares all the way down, boom, all the way back up. And so what you're seeing right in here is all this part right in here, somebody's accumulating shares. Now, how do you know that? Is because if you look close enough, what you'll see is a lot of these moves are green, right? So you're seeing buyers come in during the day and buy them. But the overnight move is what's causing this problem. You're seeing gap downs in the overnight. So gap down, buyers come in, 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 gap down, buyers come in. And we can even zoom in on the more recent data. You can see yesterday, overnight selling. Buyers came in. Today, didn't get, probably because a lot of people got afraid, whoever the last people are. But that's another way you're almost at the end, is when the last person throws in the towel. Anyways, thanks for being fans. Hope story time helped. Give you a little picture of how I do macro. Like I said, I play to win the long game. And I know my buddy Travis and some of you play that game too. But when you understand the bonds are under their heaviest short position in history, and the Fed is going to continue buying and can buy more anytime they want, and they're not going to let this thing get out of control. When this thing does reverse and all these people that sold that are short are going to have to come in and buy, it's going to be one of the most epic rallies ever. May make my other story look pretty lame. I hope it does. Anyways, I'm Steve Van Meter. Thanks for watching. We'll see you on Friday. Bye now. The content of this video is provided as educational information only. Is not intended to provide investment or other advice. It is not to be construed as recommendation or solicitation by also a security, financial instrument, or to participate in a particular trading strategy. This video was prepared by Steve Van Meter. Personal capacity, opinions expressed in this video that do not reflect the view of Alice Advising or Steve Van Meter Financial.